Good morning and welcome to the Killik and Co Market Update. It would be nice to talk about something other than interest rates for a change, but they are such a big driver of market movements at the moment that I'm afraid we do need to talk about them one more time. We have had interest rate rises this week in both the US and the UK. The US put rates up by 0.75%, and that takes its interest rate to a range of 3 to 3.25%. Here in the UK, we've had the 7th consecutive interest rate rise, and that takes our rate to 2.25%. The relatively high rate in the US has contributed to the strength of the dollar and the weakness of sterling. Here's a chart showing the pound against the dollar over the last year, and you can see that sterling has considerably weakened, and today a pound will buy just $1.12. Those holding dollar stocks, on the other hand, will have experienced the benefit of having that exposure to the dollar. On the other hand, one currency that has weakened against the pound is the Japanese yen. Here's a chart showing the movement over the last year. 1 year ago, £1 would buy 134 yen, and today it will buy 165. So Japanese stocks now look cheaper to the UK-based investor. So please do give us a call if you'd like to talk about your Japanese exposure in a little bit more detail. This week, Russia announced a partial mobilization following a number of setbacks in its war against Ukraine. And unsurprisingly, this has been bad news for investor sentiment. We tend to follow the American Association of Individual Investors Sentiment Survey, and this takes place on a weekly basis, and it asks investors whether they're feeling bearish, bullish, or neutral. Here's the data going back to the start of 2020, and the bearishness is shown by the pink. So you can see that people felt quite bearish in 2020 as we first went into lockdown, and also that bearishness has increased more recently. We can also look at the data going all the way back to 1987. So you can see here that people felt very bearish around the time of the dot-com crash and also during the financial crisis. But the good news is that when bearishness is at such a high level, it's unlikely to stay there for an extended period of time. Although past performance when it comes to markets is no guarantee of future performance, it's still really helpful to look at past performance to get a feel for how markets perform in certain conditions and how they react to certain global events. So this week we've been comparing the performance of the S&P 500 index for 2022 so far to its performance in 1962. And we've put the two performances in percentage terms on this chart here so you can compare the overall trend. Now, 1962 was the year of the Cuban Missile Crisis. So there was real concern about global conflict, sentiment was very weak, interest rates were on the rise, and it was also the year of midterm elections, so there were a lot of parallels to 2022. So as you can see so far, the performance in the 2 years has been very similar so far, but we'll just have to wait and see how the S&P 500 performs over the rest of 2022. And finally, this morning we had the mini budget announcement. We haven't yet had time to put some slides together, but we can certainly do a quick summary of some of the key points. Firstly, there have been some pretty major tax cuts for both individuals and for businesses. Obviously, people and businesses will welcome these cuts at a time when there is a cost of living crisis. However, it will mean that the government will be receiving less in terms of tax receipts, and this could mean that government debt goes up at a time when interest rates are also rising. And this has led to some concern about the state of the UK's finances, and we did see sterling weakening as the mini budget was taking place. Cutting taxes is also likely to lead to higher spending, and this could potentially be inflationary, and that could mean that interest rates will have to go up even more. Longer term, these lower taxes for individuals and for businesses will hopefully encourage more people to work and more people to live in the UK. So the Chancellor's hope is that the lower taxes will lead to higher growth over the longer term. We've also been told that the cap on bankers' bonuses will be removed, and this is quite a controversial topic at a time when many people are struggling with the cost of living. The bankers' bonus cap banned banks from paying bonuses that were more than twice the level of a banker's salary. So really what this did in practice was that it forced banks to pay higher base salaries. And actually banks don't like to do this because the salary goes down as a fixed cost. So in times when banks are less profitable, it's more difficult for them to cut their total outgoings, whereas when most of their remuneration is paid by bonuses, the remuneration can be a lot more flexible. So the hope of the Chancellor is that in removing the bankers' bonus cap, more banks will be encouraged to move to London and they will end up paying more tax here over the longer term. And then finally, we've had a cut to stamp duty. The householding sector has been a little bit weak over the last year for a number of reasons. Partly the interest rates have gone up and that means mortgages are more expensive, and also we've had the end to the Help to Buy scheme. But the cut to stamp duty should breathe a little bit more life into that sector, and this morning we have seen a rise in the shares of house building stocks. We're still going through the budget announcement in more detail, so please do give us a call over the course of the next week if you would like to talk about this in more detail. Moving on to have a look at next week, it's looking pretty quiet on the corporate calendar, but we are expecting results out from Nike. That's it from us. Enjoy the weekend, and we'll see you next Friday.